So please feel free to contact us if you want any information on any ag related subject or you need a resource, and we'll try to get that connected to you. We'd like to thank Iowa State University for providing the support for this series. And then this project is also supported by the North Central Extension Risk Management Education Grant and as well as USDA. So today we'd like to begin with Gary Wright, who's an Iowa State University Farm Management Specialist. He specializes in agribusiness management, food manufacturing, and banking, and he is going to introduce today's speaker. So Gary, welcome.
Yes, Ann and Beth, thank you both very much. I'm really excited this afternoon. I've got Michael Schoen with me. Not only is he a 20-year vet, decorated vet, I might add, but also has about that many years of grain experience, expertise. And again, we're so thankful, Michael, for you to be here. And if anybody has any questions for the farm management specialist, I'll stay around. Thank you.
Well, good morning, everybody, or good afternoon, I guess. It's a couple minutes afternoon. So today, they've asked me to come in and talk a little bit on the grain marketing, the basics to grain marketing. So again, I'm Michael Schoen. I'm your presenter for today. I'm currently the general manager at Archer Co-op Grain in Archer, Iowa. I've got about 20 years of marketing experience working with farmers. I've spent some time at an ethanol plant as a grain manager. Spent 8 years as a grain manager at a large cooperative. I'm now the general manager at a cooperative, and then also spent some time as a commodity broker. So I feel like I've got some pretty good basic knowledge of this topic that hopefully in the future, if you have any additional questions, you can reach out to some of the other speakers today, as well as myself, if you need either a copy of the slides or something along those lines. So that's a little bit of my history and who I am. I've also spent 20 years in the military and have now retired. So that's a little bit of background regarding me. But we want to get into the nuts and bolts of what really matters to you today. First off, I want to start with a disclaimer. There's always a risk of loss in trading. There's no guaranteed. Past results are not indicative of future performance. So please take that into consideration as you take this knowledge with you back home. Today's presentation, some of the goals that we have, we want to establish a baseline of knowledge to build off of, look at what the definition of risk is, and that changes with everybody's operations. So please, as you review your operations risk, make sure that you understand that before you make trading decisions. Is to provoke some thought, kind of ask what is your plan and how you want to modify that, seek enhancements to it through this presentation. Look at some insight of some things that have worked and things that haven't worked. Predominantly look at the tools of the trade. I always challenge my producers when I'm doing a presentation. I said, somebody is using these tools. Are you? Okay, so there's an opportunity out there for you to maybe change your experience a little bit and change your marketing. And then the other side is to focus on the finances, not the forecasting. I always get the question of what is the market going to do? And I always try and transition that to what am I going to do about it? Okay. So the slides presented today are available for future reference if you need them, but just reach out to me as necessary. So on the agenda side of things, we want to start off with a baseline. You always got to start with a base. Look at the building blocks. The four predominant building blocks that I'm going to look at are basis, futures, options, and spreads. And then we're going to look at some basic marketing tools or the different contract types that are available. Stay pretty simplistic, generally speaking. I'm going to give a 50,000-foot view of these marketing tools. If you need something more definitive or a better explanation, I can go into another 45-minute conversation. So we're going to stay pretty basic, but if you do need some additional assistance, please reach out to me. We're going to talk about hedging and risk management, and then how to take a margin-based approach to that. And then we're going to look at some of the how to put that all together and do some marketing, and then we'll summarize it. So one of the things that one of the quick pointers that I've learned over the years in marketing is to kind of come up with this marketer's pledge. Seems kind of corny, but there's a lot of different values in here. Taking a profit is never wrong. If you try to chase the last dollar, you rarely catch it. I found that time and again. The third one's pretty important. Typically, the only way you know the market is at its high is in the rearview mirror. So take that into consideration. Nobody knows where it is, you or myself. So because of that, let's look at how we're going to market. I'm going to market some of my crop before I harvest it. I've got a story called an Olympic swimmer example. Okay. So if any December futures contract is trading on the Chicago Board of Trade for 2.5 years before you ever take that crop out of the ground, and then it's there for 9 months after that. So 60% of any fall crop is actually 60% of your marketing window is before harvest. So if you choose not to do any marketings before you harvest your crop, that's like telling an Olympic swimmer to go 2/3 of the way down the pool, and then when they pull the trigger and say go, you're somehow supposed to catch up to him and beat him on that lap. So you need to consider what your marketing window actually is for each year's crop. So how do we do that? We place logical targets. You sell into a rising market. It's more difficult to sell as it's going down, understanding the normal market cycles, focusing on what you can control, like marketing decisions, and not what you can't, like weather. And then, the non-decisions. If you choose not to make a decision, that is still a decision. It's typically just a poor one. Your opinion of the market matters to you, but not to the entire market. So you always need to look at the other side of things. So when you talk to me, a lot of times I'll play the contrarian's point of view just to make sure that we took that into consideration. And then execution is always one of the most critical. So let's start with the building blocks. Okay, we're going to start with basis, and basis is pretty simple in its definition, I guess. It is the difference between the current cash price and the current futures price for any given month. Okay, so in this example that just popped up, we have $3.50 cash corn minus $3.70 futures price for that corn. That's a 20 under basis value. So we look at the local price minus the Chicago Board of Trade, and it gives us that real futures, or that real basis. Okay, so why do buyers use basis? They use it to attract grain. Okay, especially in times where the market is low, the futures price isn't performing like it needs to. This is a way for the buyers that need grain on a daily basis, whether it's a feed user or an ethanol plant, to capture that grain by improving the basis to entice sales. So think of it like a thermometer. Okay, when you look at a thermometer, as it goes up and down, it gets hotter or colder. Well, in this situation, to benefit the producer, the basis as it goes higher is going to benefit the producer. So a stronger basis, whereas cash would gain relative to futures. So in this situation, we have the corn futures at 370 and the local cash at 350, just like we used on the last example, a 20 under basis. So if that basis would improve from 20 under to 10 under, then that would be a 10-cent improvement in basis, and that would gain relative to futures, providing that producer an additional 10-cent benefit. The flip side of that is the buyer wants to buy it at a wider basis or a weaker basis value. So there's that conflict that you have on a daily basis of who needs grain and who wants to sell grain, and the basis will reflect the temperature of the market locally so that we can make decisions on marketing. So essentially, basis is getting it from where it is to where it isn't. So there's two factors that are involved in that. There's the local supply and demand, and there's transportation. So I'm going to pop these up because there's lots of different factors, and they won't always necessarily be in concert with each other. But the local supply and demand has lots of different constraints or added benefits that would have a factor on basis. So you look at your production side of things, like your yield and your acre base, or you can look at the demand side of things and look at the ethanol plant, whether they're making money or losing money, whether they cut back in production or they amp production up. You look at the feed usage. If the price is lower than and the profitability is there, you may see some livestock producers that will increase their slaughter weights, which would require more usage on the demand side of things. So all of that will factor in basis day in and day out. On the transportation side of things, you can see my little picture on the side of on the right hand side in the corner. The distance from any supply point to any demand point, whether it's a few miles or a few hundred miles or floating all the way across the Pacific, they take into consideration freight costs, your cost of storage. When you look at it from a global perspective, you've got different exchange rates on currency, and then you have the handling costs that's associated with all of that. So transitioning over to a couple of other building blocks, we have our futures price. So in its most simplistic term, that is the national price set for grain. It's traded on the Chicago Board of Trade. It has a daily settlement. It's determined by open outcry, and it's any futures month at any point in time. So you can look at lots of websites. You can go to CBOT websites. A lot of co-ops have websites that have that Chicago Board of Trade futures price for various months right on their front page a lot of times. So that is one of the most core building blocks, is the futures. And then tied in with that is the options. So it gets a little more confusing when we talk about puts and calls, but there's only two options. It's one is a put and one is a call. Where it gets a little bit cloudy, and I'll show you guys a matrix here shortly, is you can buy or sell a put, you can buy or sell a call, and there's risk or controlled risk with each of those positions, okay? But essentially they're trading tools for creating a floor or providing you upside potential as an insurance policy. They're not as risky as futures, okay? In the futures market, every penny that the futures gains is to your advantage. Every penny that it goes down is to your disadvantage if you're a grain seller. On the option side of things, it doesn't move necessarily. It moves in concert with futures, but not penny for penny. So you have a little bit more controlled risk, okay? So why would we consider options? Well, there again, a lot of it depends on your risk profile. Options provide you a lot more flexibility. It does provide you a level of comfortable risk. And it also doesn't necessarily provide you the utmost reward, but it does give you a reward profile. So there again, you have to look at your risk exposure. You can create either a floor underneath a unsold crop, or you can provide some kind of upside potential on a crop that's already been sold. The key component of options is how it ties in with your cash sales, okay? If you're just out there blindly buying options and you're not tying it in with your cash grain marketing, then you're nothing more than any other trader. You can be speculative in nature, you can do all of those things, but it's not true hedging and risk management. So to keep that in mind is you don't necessarily want an option to perform, okay? Think of it as an insurance policy, okay? If you are the buyer of a policy, you pay the premium. And then what that helps you do is it protects you from the risk of your house burning down or your vehicle being totaled, okay? It's a catastrophic risk protection. The insurance company will take on that risk. They get the premium from you, but they take on all that risk that if your house burns down, they have to provide you some compensation for that. So they're willing to take on that risk based on the premise that the odds of that happening are, in their mind, low. But there are potentially huge risks. So take the note at the bottom. We typically do not want insurance policies to pay out. We need to treat options similarly, and we need to treat them in concert with how we trade our grain, okay? So here's the matrix, and I'm gonna spend a little bit of time on here, but there again, I wanna emphasize cash grain sales are in concert with your option strategies. So on the upper left-hand quadrant, you have a call option, okay? If you're a buyer of the call option, there again, the buyer of the insurance policy, you pay the premium. The only loss that you are risking in that situation is the loss of what you pay for the premium, okay? This has a bullish bias, meaning you've made a cash grain sale, and yet you have this feeling or this opinion that the market may still go higher. So you buy an option, a call option, and it protects you to the upside after you sell, okay? Similarly, in the lower left-hand quadrant, as the buyer of that insurance policy, the put, again, you pay the premium. The only risk that you have is that you lose the premium. It has a bearish bias, meaning you have a bias that the market may go down. So if the market may go down and you have that feeling, why would you buy a put? Why wouldn't you just sell cash? Why wouldn't you just make a cash contract? Well, the answer to that is really in your aggressive nature of your sales. Let's say that you're 60% sold into your marketing and you're a little bit concerned about, Mother Nature and what the weather is going to throw at you. So you're like, I don't know if I can comfortably make any more sales. Well, what you do then is you go and buy a put. And what it does is it protects your downside in the event that the market heads south on you. So it protects your downside before you sell. So let's transition over to the right-hand side of the quadrants. On the upper right-hand side, you have the seller of the call. That seller, again, the insurance company, receives the premium. They hold unlimited risk. Their bet is that the market is not going to go higher, so it is a bearish bias. And the seller of a put receives the premium again with unlimited risk, and their bias is that the market is not going to go as low as the strike price that you bought that put at. So if you follow this premium, you can see on the left-hand side, it's risk aversion and a protective measure, or excuse me, the left-hand side, and on the right-hand side, the seller, that is where you have unlimited risk, but you do receive premiums for that risk. And I will show you on some contract types where both of those do come into play in some of our marketing contracts. So our last building block is the spreads. And on the spreads, simply if you take any futures price, let's say we use our current futures price, and our current futures price is in the May contract on both corn and soybeans, for example, and you look at the difference in price between that month and any of the deferred months, okay? So if you look at a July futures, for example, and you calculate the difference, you take the nearby price, and let's say that the nearby price is $5 futures, and you subtract the deferred futures price, and it's at $5.25. It's higher than the nearby futures. What that means is it's a negative 25 or a carry, a 25-cent carry. That provides you a return to storage. It provides you the opportunity to say, if I hold my grain off of the market, I will end up 25 cents better than I am today. The market can be inverted, meaning upside down, and the deferred months are lower, or it can be higher where you have a carry market. So the next page is going to provide you a graphic example of that. On the left-hand side, we have a market inversion scenario. So we got January futures at 950 and May futures at 937. You can see that the price is lower over that period of time. So what the market is telling you is it wants the grain now to be marketed rather than later. So from a producer standpoint, if you're ready to make some sales, you're going to want to make sales in the nearby month, only due to the fact that if you sell in a deferred month, you will end up with a lower price. Similarly, on the market carry side of the screen, on the right-hand side, you'll see that the market prices December futures at 350 and May futures at 365 shows that the market is providing you an incentive of 15 cents. The market is paying you to carry or hold on to the grain at a later date. This is where we have bins out on the farm is for spread opportunity, for a carry market, okay? Unfortunately, as I found from experience, a lot of producers will hold bushels off of the market waiting for, the futures price to come around. There's lots of other tools that you can use without having to hold on to the physical bushel in the bin to do that. If the market is telling you, like it is right now, if you look at the current market on both corn and soybeans, it's telling you the market's inverted. It wants bushels now, not later. And we need to respect that, because otherwise there's not much of an incentive for us to hold bushels off of the market. We're actually losing money. So then we ask ourselves, well, what is that cost? What number should I try and achieve to get a return to storage? So this is a pretty simple calculation example. If you look at any value of the grain in the nearby, let's say today it's $4, and you look at your interest costs in this example is 3%. If you annualize that over 12 months, it's about a quarter of a point per month. And then you look at a time period. How long am I willing to hold bushels off of the market? When do I want to provide my marketings? And in this example, there again, 3 months. So if we look at a standard storage rate, like what do I think I want, and we take into account the cost of the bin, the time, the opportunity cost on money, you come up with a storage rate. And this one I'd say is probably a little bit light. Corn, 3 to 5 cents a bushel, beans, 5 to 8 cents a bushel. A lot of that depends on interest rate and the price of grain at the time. But in this example, it's a little low at 2.5 cents times 3 months. So that's 7.5 cents. If you calculate that all the way across, what it gives us is a cost of carry. So what it's saying is for 10.5 cents over a 3-month period, rather than selling my grain now at $4, in order for me to quote unquote break even, I need $4.10, $4.10.5 to hold my grain for 3 months. And if you can do better than that, you get a return to storage. If you do at or worse than that, essentially you're just paying yourself to hold grain and nothing more. You're paying your interest, you're paying your costs, but you're not making any money on the bins. So there again, that's the last of the building blocks when it comes to spread and the calculation of cost to carry. So we're going to transition now to a discussion about the types of contracts. I like to break those down into 4 different levels. In the red at the top, you'll see that there's 6 different contracts, what I call marketing 101 tools. These are pretty common and simplistic. You'll see those types of tools at nearly every area that you would sell your grain. And then there's some more advanced marketing tools, which I call marketing 201, 301, and 401, that provide different levels of risk management. So the top ones are the most common. Why? Predominantly because they're the most simple to use. The marketing 201 tools are tools that you can use with either a futures or an option opportunity affixed to that cash sale. So that gives you some more market participation for a longer period of time. The marketing 301 tools are certainly what I'd call the higher risk tools, and yet they provide tons of flexibility. They can enhance your returns on your cash grain sales. And as long as they're a calculated risk, they're a very valid tool as well. And then finally, it's the 401 tools, and that's basically just straight out futures and options. The interesting part about that, the first 3, marketing 101 through 301, all have a cash price affixed to them. The futures and options do not. But eventually, when you convert that future or option strategy to cash, is ultimately when you fix that cash position. So I'll describe those here in the next couple of slides of how those operate. So starting with the basic ones, we've got marketing 101. One thing that I want to make note of is all of these contracts, 101 through 301, eventually come back to a cash contract, okay? So I want to make sure that I emphasize the fact that no matter the different tools you use, they all ultimately come back to a cash price, the actual cash value of the nearby current delivery month, if you use them correctly. Okay, so the cash contract gives you that actual cash value. It's quite simply, you call up to the elevator or to the ethanol plant that you're working for or working with, and you say, what's your price? They quote you the price for nearby delivery. And if the bushels are in there, they cut you a check. And if they're not in there, they'll expect you to deliver it within that 1 month time frame. And when you deliver it, they'll provide you a settlement and then go ahead and pay you. So that's very simplistic for all of you that are on here that have farmed in the past. You're very familiar with these. The forward contract is nothing more than taking the cash value of a future month and deciding that is the month that I want to deliver that physical bushel. And because of that, I will write my cash contract for that forward month period, because that works in your delivery program. The reason these are the most common is they're very simple to use, very simple to understand. There are no additional decision points that you need to make. It's one phone call, checks in the mail, come pick up the check. Maybe you have to deliver the product, but other than that, it's now no strings attached, no additional learning needed, no additional interactions. So it's very, very common. Most of the rest of them, of the other contracts, require some additional interaction or communication. So as we transition to the remaining marketing 101 tools, the top 2 I want to spend a little bit of time on. The Hedge to Arrive has tons of different names. Hedge to Arrive, futures fixed, basis later, no basis established. Essentially, they're all the same thing. The processors and the co-ops that use these tools just change the name slightly, but essentially they're all the same thing. So what are they? Okay, I'm going to call them Hedge to Arrives. That's the term that I use at Archer, so I'm going to use that. But keep in mind that if you go back to my previous slide where I said everything eventually reverts back to cash, then the Hedge to Arrive is just the futures portion of the cash contract. So there's only 2 components to a cash contract. There's futures plus or minus basis equals cash. So the Hedge to Arrive is just the futures half of the contract. And at some point in time in the future, there will be an expiration date with the intention that at some point in time down the road, you have to set your basis yet in order to come up with your cash price. Now, there are some reasons to use this Hedge to Arrive, not just to lock in the futures and leave your basis open, but they also provide some flexibility when it comes to your delivery period and your storage. So there are some opportunities within Hedge to Arrives to look at the spread opportunity, which we've just reviewed, If the spread is narrow at the time and you believe that the spread will widen or build a carry in your favor and get a better return to storage, you can roll that hedge to arrive to a future month when you feel that spread is at a wider number. So that's why people use hedge to rise as opposed to cash. On the flip side of the hedge to arrive is your basis contract. So a basis contract is nothing more than the other half of the cash contract. So when you look at a basis contract, you're looking at locking in only the basis. And some point in time in the future, you will lock in your futures price and with an expiration date. So these are probably a little more popular with the producer, and I kind of contemplated that for a while, and I thought, why is that? And really, that's the only negotiable part of a cash contract typically. So if a producer feels like the basis is too wide and they're not satisfied with that, they can try and negotiate a better basis opportunity. My only cautionary statement is that I've seen it time and again where somebody will try and negotiate a 5-cent better basis while the futures goes down 25 to 50 cents. So just be sure that you're aware of the time frames that you need to kind of say, well, futures is much more important than basis when it comes to, you know, that adage, stepping over $1 to pick up a dime. Just make sure that your futures price is focused on predominantly before you worry about basis. The last two contracts, not going to spend a lot of time on. It's just deferred pay and price later. The price later contract allows you to deliver that physical bushel, leaving your basis and your futures open until a later date. And your deferred is the flip side of that, where you have all of your cash settled and everything. You're just deferring getting paid until a later date, just due to some tax implications that you may have on your operation. So we're going to transition to the 201 through 401. There again, I'm not going to spend a whole lot of time. This is more of a 50,000 foot level conversation because as you get to more advanced strategies, those are really individual face-to-face, I call them whites of the eyes conversations that you have with your broker or the people that you deal marketing with. They really need to have conversations because that's just not a one and done conversation. They don't just call up, say, what's your price, and then go ahead and cut me a check. All of these additional tools require additional decisions. So on a minimum price, you've sold the grain and you're worried about the market going higher, so you buy the call. So that gives you you pay specific money for a strike price. They reduce the price of the cash contract. Your risk has now been averted and you still have some upside. The extended price contract, just like a minimum price, rather than a long call option, you're actually just straight out buying futures. So you've made that cash sale. You still want market participation. So you've basically moved your risk from the physical risk over to the paper risk. And you still have upside on that on the future side of things. Be careful because if you're long futures, every penny that you gain above your position is a gain to your position, but every penny that the market goes down is a loss. On the 301 positions, we have the bonus premium. That's a cash contract. Now here we get into the insurance companies side of things. So you're going to transition from the insurance buyer to the insurance seller. So you've sold a cash grain contract and you decided, you know what, I'd like a little bit more premium out of this market, or I'd like to extract a little more premium on my cash. So I go out and sell an option. Remember, when you sell an option, you receive that premium. If you sell that option, there is some risk. The risk is wherever you sold it at, if the market turns around and goes north of that strike price, you could be subject to margin calls. So there again, you have unlimited risk. You need to be prepared for that. And you need to say, well, for that risk, I received a premium. The accumulator contract, all I'll say is that they're extremely flexible. They have tons of different styles. And essentially, you have a futures price fixed at a premium, a lot of times well above the market. But with that comes risk. The risk is that the total quantity of bushels could change. The basis could change. There's a lot of changing dynamics in that contract. So make sure that when you do look at that contract, that you spend time reviewing what your risk exposure is. And then finally, like I said before, the futures and options is your 401. And that allows you, the marketing 401, that allows you to have direct access to the Chicago Board of Trade. It kind of keeps your cards covered. Okay, so if any of you play cards out there, you'll know that you don't want the competition to see your cards. By using futures and options, you are not showing your cards or you're not selling your physical cash grain to any local market until you're ready to. And what that allows you to do is maybe provide you some flexibility on basis conversations and negotiation down the road. So let's talk about the use of those tools now as we transition to a discussion about making a plan. Okay. So we're going to start with the definition of hedging. All right. Hedge is an investment. It reduces the risk of adverse price movements. This is not speculation. This is not, I think, I believe. This is, I am satisfied with a price. And with that price, I'm going to go ahead and sell futures to lock it in. If you're a livestock buyer and you want to buy feed, then you be long futures. You're going to buy that futures price. Simply put, hedging is two words. I've used these since I began marketing 20 years ago. Price protection. You are protecting a price. It's not speculation. It's not guessing the highs and lows of the market. It's not selling because you got a bill due. It's not any of that. It's just protecting a price that you deem adequate. So on the risk management side of things, there's two schools of thought. And the first school of thought is self-insurance, the self-insurance approach. I'm going to write out the highs and lows. I'm just going to kind of bet on the come. Unfortunately, very few operators can adopt this approach. The banker's not too keen on it. The other side is the more desired approach. It's the proactive risk management. It's a way for us to reduce volatility in earnings, protect against disaster scenarios, and it's a more disciplined approach. So I'm going to focus predominantly on the proactive risk management. My question to you is you need to ask yourself, which one are you? So we have three types of risk when we look at that. We have the price level risk, which by far and away is the largest one. We have all of the futures price changes that changes every day. The risk is large and it's difficult to predict. We talked a little bit about our basis exposure and what that means to us. But there again, my cautionary statement is don't step over $1 to pick up a dime. Your first level of risk is your price level risk. So make sure that you have that controlled before you worry about basis risk. And then finally, it's your spread risk. And that's the even lesser so is just a question of, do I get a return to storage or not? So as we evaluate those risks, certainly focus on your price level risk. So when you go to the individual operation, we have to ask ourselves, how do we quantify risk? All right. We need to focus on the grain margin or the gross margin of our operation. It's not about one particular sale. I've seen time and again where people freeze up on making additional sales because they felt their first sale was too low. The only way that you can capitalize on in an up-moving market is to make additional sales. So as we look at that, make sure that you're focused on the entire gross margin. So we need to focus on what is required to cover our operation. That is only going to be known by you. The marketers that you hear on the radio or people like me that make recommendations, they're going to provide general market guidance, but it's only you that knows what it costs to operate your farm. And because of that, it's only you that ultimately can quantify that risk. There is a natural tendency for people to shy away from this because it's not the fun part of farming. I will tell you that. There's nothing glamorous about this job, but it is absolutely essential when you quantify your risk. So let's develop this program. Let's take a look at what that maybe looks like. Some key points is prices are unpredictable. The markets every day are in a constant state of price discovery. It's based on the changes in news. I call it the Baskin-Robbins flavor of the day, okay? It's going to change every day based on what it feels it needs to do to try and evaluate a price. So as we develop our risk management program, our job is to manage that risk, not to try and forecast that Baskin-Robbins flavor of the day, okay? View your business as raising a crop, not trading the commodity. You do not need to be a farmer to trade a commodity. You could, be at any uptown business and be a trader. So our core business of raising a crop has to be our primary focus, and that comes back to hedging or risk or price protection. We need to set realistic expectations, and then we'll make adjustments as we need to for those seasonal tendencies, for I call them black swan events or things that we didn't predict. And we make those continual adjustments throughout the year. If we establish a baseline yield and we feel like the crop is moving along better than we anticipated, we need to make those yield adjustments because that makes certainly an adjustment to our margin perspective. So it can allow us to sell additional bushels, make additional sales for an opportunity down the road. So the big picture. Creating a risk management policy. Sounds a little bit corny, but I've seen time and again, some of the most successful people are those that define their objectives and more importantly, treat it like a business. write down their goals so that they can kind of recommend to themselves what they need to do. And the way that they do that is through the decision-making process, okay? The decision-making process is where do I want to be this time next year? How much is too much? What are you comfortable with? What tools are you going to use? What yields can I use? Look at the what ifs. All of that needs to be answered by you. Because if somebody makes a recommendation that you need to be 100% sold by the 10th of September and you don't feel comfortable with that, then that's not a policy that you can follow. So you need to make sure that you understand what risk aversion, what tools, what options, what crop insurance, all of that goes with that. So then when we get to the nuts and bolts, after we've made that policy, now we're going to talk about strategy. That's the actual doing part. This is the detailed program that you put in place to manage risk. So there's a couple things, predominant things that you need to consider when you look at that is guarding against disasters and capturing attractive margins. Quite simply, there's ways that you can guard against disasters by using the crop insurance and option tools that we talked about earlier. And then the attractive margins is just being able to recognize where and when those actually occur. And I'll give you a little bit of guidance towards the end of the conversation here about that. The problem is human nature. All right. When the producers tend to get bullish, it seems to be they're almost always bullish at the top, and equally they're almost always bearish at the bottom. So they have give up sales at the bottom, and they have no, I'm not going to make any sales at the top. So left unchecked, human nature often goes absolutely against effective pricing and risk management strategies. So the way that we cure that is to focus on our margins and develop a structured program with preset targets. If we don't do that, we will hesitate and we will not execute. So here's your margin-based structure, all right? Essentially, you guys are managing margin between, guys and gals, excuse me, you are essentially managing margin between input costs and the revenue that you receive from the crop. So how do we do that? First, develop a standard margin calculation that reflects major price risk, okay? There will be some risks that you know. So when you look at going into the season, you're going to know what your land payments are. You're going to know what your machinery costs are other than repairs. And then there's going to be your unknown costs. As those unknown costs become known, you need to, again, make your adjustments, make your adaptations to reflect what that means to your opportunities. Create a margin history. This is over time as your farm continues to evolve. You need to look at how that margin history has evolved. People that have newer equipment maybe have less repair bill, but as that equipment gets older, they're going to have a bigger repair bill, but they may have less machinery payments. So you need to create that margin history to reflect that frame of reference. Defining what a good and bad margin is, there again, I will talk to you a little bit in some future slides about the ranges, and then scaling in and protecting against losses. Again, to emphasize that you can't make one big sale all at once. It'll make your stomach hurt. So scaling in as the market moves higher is the most protective way that you can do that. And then to protect from that negative margin scenario with crop insurance and put options. So looking at the structured approach, I'm going to pop all these up here quick. Again, preset margins, capture opportunities under the current conditions, okay? Those opportunities you need to recognize in the current conditions, not the what ifs. You can what if yourself to death. That allows for better decision making and takes a lot of the emotion out of the process and adds your discipline. So for all of you vets out there, think of the military in combat. If they are taught emotion before discipline, how do they go on to complete a mission once they see a fallen soldier? It becomes very difficult to do that. So if you put your emotion ahead of your discipline, it will be very difficult for you to succeed at your risk management program. So just take that into, put a little thought-provoking knowledge there, because the alternative to this is what I call your hair's on fire. If I study the markets long enough, I can outperform it. If I wait long enough, something better will come along. There's words like stress, fear, anxiety, avoidance, hesitation, guilt, you name it. That's on this guy's mind right now. And that is not healthy. And it is not a predictive way for you to perform. Okay, so nuts and bolts. How do we operate through all that clutter that I just provided? Simple. Keep it simple, follow through, targets and execute, follow the seasonals. Seasonal patterns occur because the market by default knows some things about the crop each year. So I'm kind of a seasonal guy. So I'm going to show you 3 easy steps on how. First, consider the overall supply situation and establish your expected ranges. Okay. Supply situation and ranges. So what ranges do I use? What do I use? Okay. Here is a 20-year history of the monthly price of corn. 20 years. So you'll see on the left-hand side at about 2006, the market spiked higher. That was when ethanol really started to kick off, 2004, 5, and 6. We kind of created our own internal demand structure of demand that wasn't going to go away. You'll see some blips on the radar way on the top side, the first one being in 08, the next one being consecutively in 10, 11, and 12. Those are years that we had production issues. And then you kind of have that sleeve in the middle. So I'm going to talk about the middle. The far left side, I'd say, is pre-ethanol. So anything below that first blue line, below $3, is kind of pre-ethanol. So we talk about that new era of prices. I would say that, yes, this proves that we are in a new era of prices. And that era of prices, whereas the top side used to be $3, it's now the support side. And the top side normally would be in that, I'm going to call it 4.25 range. So that's in an environment that I'd call typical. The typical environment being, we live in the heartland of the world, we feed the world. Typically, we're going to produce for the world, and we're going to have prices that are decent, but not just gangbusters. So if you look over the course of that 15-year period from 06 to 2021, you can see that we spend most of our time in that range. And what I would say is if I was to look at making a plan, over time, I would look at my December futures targets between 415 and 450 from a scale up standpoint. Now, does that mean I'm going to sell all of my bushels at that price? No, not necessarily. I may keep back some bushels for these big moves, but I also have to anticipate the fact that these big moves do not occur on a regular basis. They're erratic. They're extremely volatile. We don't know where the high is. We don't know when it's going to fall apart. We just have to leave some of the bushels for it, not all of the bushels for it. But there again, take a look at that, and I would use that as my baseline. You can see on the far right-hand side what we're going through right now. We're kind of going through a supply threat. We're kind of concerned about China demand and what that could mean for our supply. So similarly on soybeans, not a lot of difference. The reason 2006 the market started to move was because we were in an acres battle. Soybeans can't give up acres to corn and just lay down and die. So they need to kind of follow in step with corn. Similarly, you see some spike highs where the funds have really overdone things. And you do see a little bit more volatility in that central section there that I would use as my marketing target between, I'm going to call it between $10 and $11. And the reason that is because we're a hemispheric crop. There's still a large portion of the crop that comes from South America, from Brazil and Argentina. And because of that, you can see a little bit more interesting dynamics. And yet you can still draw lines that says, generally speaking, this is the range that we need to be in. So having said that, let's talk about the seasonal trends. Let's not buck these seasonal trends. We now know what the ranges might be. So kind of a busy chart here, but the purple line is going to represent, since 2005, what the average seasonality price of corn has done. Now you'll see the blue dashed lines is to 2020. Well, thank you, COVID, for that. So there are some counter seasonal moves that can occur, but I broke down each year into 4 different sectors to try and simplify things. The first one being front-loaded sales, meaning I don't have any idea where and when the high will be. The market typically starts to trend higher during this period of time. So I'm going to use some premium contracts. If you look at there, I have an example, bonus premium and accumulator. That's your marketing 301. So maybe 5 to 15% of my sales during that period of time. And then as I transition into what I call the sweet spot, let's not get cute here. Let's keep it simple. Let's make sales. Let's clean up our old crop sales, and let's start making some new crop sales. I would not mind being 30 to 60% sold during that time period. At some point in time, typically, the market will tip over on itself. What will happen is we'll hit the 4th of July, we'll hit pollination, and everybody will go, I think we have a crop. So based on that, the market has more known, there again, price discovery, and as more becomes known, it starts to go, well, I know quite a bit about this market now. I don't feel like I need to put a risk premium in. So the market starts to fall apart, and that's that hope and pray period. That's a period like when it goes down, you never sell enough. You never have enough sold. Okay. You've always got next year's crop or portion of last year's crop. So there are tools, again, that you can transition to back to the bonus premium and accumulator to try and capture some additional premium to bring you back up into that sweet spot to make one last sale. And then the final area is the harvest lows. That's kind of the stay away zone. I try and limit my sales there. I know that if I have a big crop, for example, that I didn't anticipate, I'll bring some more bushels to harvest, and that's okay. But what I want to do there is maybe consider some re-ownership, some marketing tools like your extended price and your minimum price contracts. And what that'll do is that will allow you to get back to that next year's seasonal when you go back to the left side of the chart. So all of those times gives me an opportunity to try and find a way to get closer to that sweet spot or to those front-loaded sales. So that's kind of how you read that chart. And surprise, surprise, soybeans aren't that much different, okay? So I'm not going to berate this any other than the fact that if these seasonals over a 20-year period make sense, it kind of gives you some free chicken of here's your window, and these are the areas and where and when you need to be selling. So my next slide is a little bit depressing. Here's the unfortunate reality. If you look at a 20-year history of USDA actual farmer data of when the farmer has sold, what it will tell you is everybody stays away from the sweet spot, and most of them sell during the harvest lows. Well, why is that? Well, one of the reasons is that emotion, that fear of not knowing what your crop is going to be, so everybody kind of tempers their selling mood. What we need to do is, even if we just transition a portion of our sales over to the sweet spot, even if I'm a 15% seller of grain before harvest and maybe I sell 25%, put small goals and take little bites out of an elephant at a time rather than trying to eat it all in one sitting. My goal would be today is if there's anything that you can learn is to try and get a few more sales in that sweet spot, because more times than not, the 20-year history shows based on my seasonals that you're going to be better off rather than selling in those harvest lows. And lastly, this is the simplest slide that I got. There's nothing else I can say about it. You got to execute. There's nothing in this market. There's no tool that you can learn or use. If you don't use them, I could talk tall and blue in the face and we're not going to learn anything. So just please, when you have your plan in place, use those tools, go ahead and execute and get something done. So to wrap up, hopefully I'm moving along well on time, but putting it all together, I got two last slides. Execute, don't put your head in the sand. Take out that emotion by using targets. Follow your seasonal patterns. Do not overanalyze. That paralysis by analysis. You can what if yourself to death. Adapt, okay? I always challenge producers and say you make seed choices and changes every year, and you make machinery choices and changes every year. But I find very few people make changes to their marketing strategies. We have to be adaptable to changing markets, just like we're adaptable to changing seed types and fertilizer rates and whatnot. If your opinion is correct, that's great. But find somebody that's a contrarian that can not necessarily prove you wrong, but challenge you to say, did you think of this? Not making a decision is still a decision. It's usually not a wise one. And be sure you know what really matters in the market. I've had discussions with guys about South African weather and things, and it's just not productive or healthy for us to worry about some of those things. Transition that discussion. What's the market going to do? And transition it to what does it mean for my operation? Pricing and hedging during duress is usually at the worst time. So please, that's part of that planning process. Make sure that you're proactive in your planning, the market dynamics as they change. And I will say, when you look at this 4th of July pollination timeframe, usually the most difficult sales to make are usually the best sales made, because as that market starts to tip over on itself and that more becomes known about the market, it's hard to make a sale on the way down, but usually that down keeps going down. It can be uncomfortable to make decisions on the fly, so make sure that you're using your offers. We always have a level of uncertainty. There's always tons of black swans and what ifs, but just make sure that it's in line with your plan. Last thing, remember the apprehension you have about making sales about, well, what if it goes higher? Compare that to the uneasiness you have when the price goes down and you have a bunch of unpriced bushels to sell. So recognize that trap of assuming no decision is somehow easier and carries less risk, but because it doesn't. So with that, I want to certainly express my gratitude for the opportunity to be in front of each one of you. I guess I will turn it back over to the administrators now to see if they have any questions. There's my contact information if anybody does want to drop me an email to have a further discussion or needs a slide deck from there. So thank you.
Thank you. Thank you so much, Mike. I really, really appreciated with those building blocks. I think we all need those sometimes, even if you've been marketing a crop for a while. So I have lots of questions and I've had some come in. So get ready.
Great.
I think you'll know all the answers too. So you mentioned, I think you kind of addressed this. I think the question came in before you showed those charts with the seasonals.
Mhm.
And I just wanted to make sure the soybean chart showed that average line was for both the corn and soybean charts you had was back to 2005, right?
Yes.
That was kind of
Yes.
okay. And then it had just the entire black swan of what 2020 was for
Yes.
everything.
And you'll see that variability each year.
Yeah. Yeah. And what do you did you give a specific percent maybe of what to sell before harvest or to look at pricing before harvest when you're discussing
It really
those?
depends on what comfort level you are. If you look at the seasonal slides, a lot of my recommendations are 5 to 15% from January to March, and then 30 to 60% in that March to 4th of July timeframe. I know that's pretty aggressive, that's pretty bold, and yet we can kind of morph that a little bit based on your aggression level. I will also say that one of the key things is there again, I go back to the very first thing that one of the first things that I said is, December futures is trading 2.5 years before you ever take it out of the field. So, being 75% sold on that very last, July 4th, that hits our goal. That gets us 60 to 70% within that marketing window. What I find is that a lot of producers are still cleaning up old crop sales, whereas the numbers that I was using was for new crop. That's before they ever even take it out of the field. So you can't do that all in 1 year. So I work on a transition plan with people on how to go from not sold at all to selling a little bit to selling a little bit more. And it's a 3 or 5 year evolution, truthfully.
Yeah. So that kind of leads into another question I had, which was if you have somebody who wants to look at improving their marketing, would you suggest first they just become more disciplined in the timing, or that they try one of those different contracts? I mean, if they want to get their feet wet on improving their marketing besides unplanned cash sales, where would you recommend they start?
I've seen guys that just use cash sales, the most simplistic contract. It still comes down to finding a number that works, scaling up from there, and using the seasonals as your guide within the price range that I afforded. You don't have to do any of those other marketing 101 through. If you're deathly afraid of futures and options and whatnot, don't use them. Go use cash contracts, follow the seasonals within that price range, and you'll still knock it out of the park.
What percent of this is just based on your experience over the years, I guess, what percent of producers do you think have a good handle on their cost of production?
Define good. I think producers, they know the big picture stuff. They know their production costs when it comes to fertilizer and seed and whatnot. I think that where things get cluttered is they understand the financial side. They maybe understand or speak to someone or have an opinion of the market, but they don't synergize those two together. They keep them separate. I have an opinion of the market. I think the market's going to do this, but then they don't take into consideration their finances. I mean, we're sitting here today with corn at 525, and I will tell you right now, I, along with many other individuals that I speak to in the industry, have some of the lowest ownership going into this next fall. And that tells me that producers are almost locked into non-decision. And that's a scary thought because there's some wonderful pricing opportunities. And I understand why. There's some producers that felt like I sold too early, I sold too much too early, and I'm trying to capitalize on another opportunity. The problem is we don't know when this ends. We may have an opinion, but we don't know when it ends. And if you look at some of those volatility charts in 2008, 10, 11, and 12, this is not just a short little sigh and breather. I mean, it's usually a dramatic rocket down because what's happening is the producers on the other end, the ethanol producers, the livestock producers, the people that we make that crop for they're hurting. They don't like these prices. They're going to find alternatives. They're going to start killing pigs at a lighter weight. They're going to start slowing down their ethanol. And because of that, the market all of a sudden scratches its head someday on a USDA report and says, whoa, we got a lot more less demand than what we thought, and then the market just collapses. So we have to take that into consideration.
Very good. Well, not necessarily good, actually. I really liked the comment that human nature can go against effective pricing. Like, who do you think make the best marketers? The person who raises the crop or the person who's maybe in charge of the finances on the farm?
The person doing the books.
So I was curious based on your experience. We hear a lot that maybe.
Honestly, I will tell you that I've worked, I've had lender forums where I've brought lenders in and provided them a presentation in the afternoon for the very same presentation that I give to my producers. So it puts them on the same page. So they know a lot of these marketing tools, the one that I've worked with, because I think it's important that it isn't just one person making this decision, whether it's your lender or your spouse or your partner or something like that. Two heads definitely work better than one, even if it's me providing that contrarian viewpoint just to make sure that you've thought about all the different factors. I think it's very important that you seek out some kind of knowledge from someone else that can keep you grounded, whoever that is, whether it's somebody that's doing your finances or somebody that has absolutely no marketing experience at all.
So I probably have more questions, but I'm about out of time. So thank you so much. And I'm going to turn the mic over to Beth to see if she has any last comments before we would wrap up today.
Thanks, Ann.
Thank you. Thank you, Mike, for that great presentation. Lots of great information. In your comments, you reminded me a lot of some of the producers that I was working with over my years at USDA, and the years that the crop years they would carry over from year to year because they were afraid to use some of these tools. So I appreciate all of those comments. I made a lot of notes about some of the things that you said, and I've also worked with a lot of producers' wives that were the ones doing the marketing. Kind of relates back to Ann's question, but great information today. I appreciate just starting it at the basics. So I want to thank you and Gary for joining us today, and then also remind everybody of next week's program that will be on risk management as it relates to livestock production. So we look forward to another great event here. And then for those of you that want to review this presentation or want the slides, I will make sure that I get all of that out to you. And I'm also be posting that and providing a link on our Facebook page and on our website. So again, Mike, thanks. It was a great information today.
Thanks for having me.
So with that, we're going to close out the session. Thank you all for joining us and have a great day.